A taxi pulls up, the meter starts ticking, and 30 minutes later, you're at your destination, having paid maybe $15 or $20. Simple enough from the back seat. But run the numbers from the owner's side of that windshield, and the picture gets a lot more complicated. Long before ride hailing apps existed, taxi companies were already fighting a war on razor thin margins. One where the car itself, the license to operate it, and the person driving it all pull money in different directions. Some fleets still make solid money today. Most don't. In this episode, we'll break down how a taxi company actually earns its revenue, where the vehicle and driver costs go, what licensing and regulation really cost, and why so many traditional taxi operators have struggled since ride hailing apps entered the picture. Let's get into it. A taxi company's revenue looks simple from the street. Someone rides, someone pays the meter, but a fleet operator actually pulls revenue from several distinct sources. First, metered fares. This is the core business. Distance and time-based charges collected from street hails, taxi stands, and phone dispatch. In most markets, this is still the largest single revenue category, though its share has shrunk considerably wherever ride-hailing apps have taken hold. Second, dispatch and booking fees. A company running a call center or app-based dispatch system typically adds a small fee on top of the metered fare for the convenience of pre-booking. Airport pickups and corporate accounts are the biggest source of this. Third, vehicle leasing income. Many taxi companies don't employ drivers directly at all. Instead, they own or lease the vehicles and the operating medallion, then lease that whole package to a driver for a flat daily or weekly rate. In this model, the company's income isn't tied to how many rides the driver actually completes. It's a fixed rental fee, which shifts nearly all revenue risk onto the driver. Fourth, corporate and contract accounts. Hospitals, hotels, airports, and corporations often sign standing contracts with a taxi company for guaranteed transportation at negotiated rates that are usually lower per ride, but come with predictable high volume demand. Fifth, advertising revenue. The exterior and interior of taxis are valuable ad space. Wraps, rooftop displays, and in-cab screens generate a revenue stream that costs the company almost nothing to produce once the ad contract is in place. Sixth, medallion or license value itself. In markets where taxi medallions are a limited transferable asset, some companies generate revenue not from driving people around at all, but from leasing or eventually selling medallions to other operators. Though this revenue stream has collapsed in most cities since ride-hailing platforms entered the market and medallion values crashed. So a taxi company's total revenue is really a blend of these channels, and the mix matters enormously. A company relying heavily on medallion leasing income is exposed very differently than one relying on metered fares, and the collapse of medallion values in many cities over the past decade has wiped out what used to be a company's most valuable asset almost overnight. The vehicle itself is one of the largest and most predictable cost centers in the business, and it starts before a single passenger ever gets in. Purchase or lease cost comes first. Taxi specification vehicles, often requiring reinforced suspensions, specific safety equipment, and commercial grade interiors, cost more upfront than a typical consumer car and depreciate faster given the mileage they rack up. Many companies now lease vehicles instead of buying outright, trading a lower upfront cost for an ongoing monthly obligation that doesn't go away even during slow weeks. Fuel is the next major line item, and it's also the most volatile. A single taxi can easily log 200 to 300 kilometers a day. At that mileage, a spike in fuel prices translates directly and immediately into thinner margins, since fares rarely adjust as quickly as fuel costs do. This is part of why many fleets have shifted toward hybrid or electric vehicles in recent years. The higher purchase price is offset over time by dramatically lower fuel costs per kilometer. Maintenance and repair costs scale with mileage too. Brakes, tires, and transmissions wear out far faster on a vehicle running 16 hours a day than on a personal car. Fleet operators typically budget for far more frequent servicing intervals and unplanned repairs. A failed transmission, a cracked windshield from debris on the highway can take a vehicle out of revenue generating service for days at a time. Vehicle downtime is an underrated cost in its own right. Every hour a taxi spends in the shop instead of on the road is an hour of lost fare revenue, not just a repair bill. Well-run fleets track this utilization rate closely because a vehicle sitting idle for maintenance is effectively still costing the company its full fixed overhead while earning nothing. Depreciation and eventual resale value round out this cost line. A taxi that's logged hundreds of thousands of kilometers sells for a fraction of its original price, and companies have to plan vehicle replacement cycles carefully. Replace too early, and you waste remaining useful life. Replace too late, and rising maintenance costs eat into the margin faster than a new vehicle payment would. How a taxi company pays its drivers fundamentally shapes its entire cost structure, and there are really two dominant models. In the commission model, the drivers paid a percentage of the fares they collect, and the company takes the rest to cover the vehicle, insurance, and dispatch services. This aligns incentives reasonably well. A driver who works longer hours and takes more fares earns more, and the company's revenue scales directly with driver activity. But it also means the company's income is fully exposed to how hard any individual driver chooses to work on a given day. In the lease model, the driver pays the company a fixed daily or weekly rate for the right to use the vehicle and medallion and keeps 100% of whatever fares they collect above that. This gives the company predictable, guaranteed revenue, regardless of how busy the driver actually is, but it also means a slow week is entirely the driver's problem, not the company's, which has drawn significant criticism and, in some cities, regulatory scrutiny over how much financial risk gets pushed onto drivers. Driver shortages and turnover add a real cost on top of either model. Recruiting and vetting a new driver, background checks, licensing verification, vehicle familiarization, takes time and money, and in markets where ride hailing apps offer more flexible hours or better take home pay, traditional taxi companies frequently struggle to keep experienced drivers from leaving. Multiple shift vehicle use is one of the more effective ways companies control this cost. Running two or three drivers on rotating shifts against a single vehicle spreads the fixed vehicle cost across more total driving hours and fare revenue, which is why many fleets prioritize keeping every vehicle in near constant use rather than owning more cars than they can staff efficiently. Taxi companies operate under some of the heaviest regulatory burdens in the transportation sector, and that regulation carries a real price tag. Medallions or operating permits, where they still exist as a limited asset, historically represented enormous sunk costs. And in some cities, a single medallion once sold for over $1 million before raid hailing disrupted the market. Companies holding these permits carry that cost either as a loan they're still paying down or as a now devalued asset on their books. Commercial insurance for taxis runs dramatically higher than personal auto insurance given the mileage, passenger liability, and accident exposure involved. This is one of the largest recurring fixed costs a fleet faces, and premiums have risen steadily in many markets as insurers reassess risk in an industry facing declining ride volumes. Driver licensing and background check requirements, commercial driving permits, criminal background checks, medical fitness certificates, all carry both direct fees and administrative overhead to track and renew across an entire fleet. Local regulatory compliance, including vehicle inspection requirements, accessibility mandates, and city specific operating rules, adds ongoing administrative cost. In many cities, taxi companies must also pay into funds supporting wheelchair accessible vehicle requirements or municipal transportation authorities, costs that ride hailing competitors have often been able to avoid or minimize under looser regulatory classifications, creating a genuine competitive disadvantage for traditional fleets. After all these costs are accounted for, a traditional taxi company's net profit margin typically lands somewhere between 5 and 15%, and in many cities hit hardest by ride hailing competition, it's been pushed toward the low end of that range or into outright losses. A rough breakdown looks like this: vehicle costs purchase, fuel maintenance around 30 to 35% of revenue, driver compensation or lease model overhead making up a large share depending on the model used, insurance and regulatory costs around 10 to 15%, dispatch and administrative overhead around 10%, leaving somewhere in the 5 to 15% range as net profit. The medallion owning companies of a decade ago had a very different profitability picture. The appreciating value of the medallion itself often functioned as the real profit engine, with day-to-day operations breaking roughly even. When medallion values collapsed in many cities following the arrival of ride-hailing platforms, that hidden profit source disappeared almost overnight, exposing just how thin the underlying operational margin actually was. Utilization is the single biggest lever on profitability here. A vehicle running 16 hours a day across 2 driver shifts generates dramatically more revenue against the same fixed vehicle and insurance cost than one sitting idle for half the day, which is why the most profitable operators obsess over keeping every car working as many hours as possible. First risk, ride-hailing competition. This is the risk that's reshaped the entire industry over the past decade. App-based platforms offering more convenient booking, transparent pricing, and often lower fares have taken enormous market share from traditional taxi fleets in nearly every major city. Second risk, fuel price volatility. Since taxis log such high daily mileage, sudden spikes in fuel costs hit margins immediately and can't easily be passed on to customers, since metered fares are often regulated and slow to adjust. Third risk, driver shortages. As alternative gig economy driving options multiply, taxi companies increasingly compete for the same pool of drivers against platforms offering more flexible hours, creating constant recruitment and retention pressure. Fourth risk, regulatory change. Because taxis operate under heavy local regulation, a shift in licensing rules, fare caps, or medallion policy can dramatically affect the value of a company's existing assets and its ongoing cost structure with little warning. Fifth risk, vehicle downtime and maintenance surprises. An unplanned major repair pulls a vehicle out of revenue service exactly when the company can least afford the lost income, and fleets without backup vehicles feel this shock immediately. Sixth risk, medallion or asset value collapse. Companies that finance their growth by borrowing against medallion value took on serious financial exposure when that value dropped sharply in many markets, leaving some operators owing far more than their underlying assets are now worth. Seventh risk, reputational and safety incidents. A single high-profile accident, driver misconduct case, or safety complaint can damage a company's standing with corporate accounts and regulators alike, especially given how quickly incidents now spread on social media. Eighth risk, seasonal and cyclical demand swings. Airport and event-based revenue can be highly seasonal, and an economic downturn that reduces business travel or discretionary spending on cabs hits fixed costs, leases, insurance, driver pay, that don't shrink along with revenue. Looking at operators who've managed to stay profitable despite ride-hailing competition, a few patterns stand out. Maximizing vehicle utilization through multi-shift scheduling, building strong corporate and contract accounts that provide predictable, less price-sensitive revenue, investing in their own dispatch technology to compete with app convenience, and diversifying into adjacent services like corporate shuttle contracts, medical transportation, or airport-specific licensing that ride-hailing platforms can't easily access. Companies that shifted early toward hybrid or electric vehicles have also protected their margins against fuel price volatility more effectively than fleets that didn't. And operators who invested in their own booking apps rather than relying purely on street hails and phone dispatch have been able to claw back some of the convenience advantage that pulled riders toward ride-hailing platforms in the first place. The through line across nearly all of them is the same, treating utilization, not just fare volume, as the metric that actually determines whether the business is profitable. Running a taxi company was never as simple as putting a car on the street and waiting for passengers. Between vehicle costs, driver compensation models, heavy regulation, and now direct competition from app-based platforms, the traditional taxi business has had to fight harder for a thinner margin than almost any other transportation model. The operators still standing today aren't necessarily the ones with the most cars. They're the ones who kept every vehicle working the most hours, built revenue relationships that didn't depend on street hails alone, and adapted fastest when the rules of the industry changed underneath them. If you're evaluating a taxi or fleet operation, the numbers worth putting side by side first are vehicle utilization rate, cost per kilometer, and the split between fixed and variable driver costs. That combination tells you more about the health of the business than total ride volume ever will. Thanks for watching, and we'll see you in the next episode.